So, in order to get the payment plan that you can afford, it's important for you to understand the mindset of the IRS. In other words, how do they see your tax problem? In this chapter, we're going to walk you through the 5 ways to resolve your tax problems. The IRS calls these 5 ways collection alternatives. We are also going to discuss which alternative is best for you. Typically, the IRS will look at your tax problem and assess which one of the alternatives is in their best interest. The first collection alternative is to determine whether you have the ability to full pay the liability, meaning can you liquidate an asset? Can you borrow the funds from a family member, a friend, or a bank and pay down the liability in its entirety? The second collection alternative is a payment plan. The IRS calls this an installment agreement, and I will use both terms interchangeably through the course. The third collection alternative is called currently not collectible status. I like to think of this as an imaginary status because while you're in this status, a dormant status, the IRS does not take enforcement collection against you, meaning they will not levy your assets. When you are currently not collectible or in a financial hardship status, you as the taxpayer acknowledge you owe an IRS debt, while the IRS acknowledges that you're unable to pay them right now. This status is temporary and may last for a period of 2 years, while interest and penalties will still accrue. The fourth collection alternative is called an offer in compromise. You may have seen commercials or radio advertisements that say, "Act now, hurry up, we'll settle your tax disputes for pennies on a dollar." What they're referring to are called offers in compromise. And this is essentially a settlement with the IRS, where you are offering a reduced amount to satisfy the entire liability. The last collection alternative is bankruptcy. Now, this really isn't a collection alternative that the IRS offers, but if you qualify, this collection alternative could resolve your tax debt. And we will discuss all of these collection alternatives in this chapter. The types of tax liabilities that payment arrangements will usually be considered for is when the taxpayer owes income taxes. So you file your personal tax return and there's either a balance due, or maybe you left off some income on your tax return and so they did an assessment and they're attributing more taxes owed. Trust fund recovery penalties, that is when you own a business or you're a responsible party in a business and the business doesn't pay the payroll taxes. Well, the IRS will then assess trust fund recovery penalties against the responsible person and the person that was willful. And these are all terms of art, but the responsible person and the person that was willful in not paying taxes. It's the IRS's way of ensuring that someone is going to pay those payroll taxes, be it the business or the individual that's responsible for having to pay taxes. Employment taxes, those are usually 941s, 943s, or 940s, and those are the quarterly and annual reports that business owners typically have to file and pay the taxes on as it relates to payroll taxes. Shared responsibility payments, that's usually associated with the healthcare, or, you think about the healthcare penalty. That's that type of, it's not really a tax, but it's an assessment that an individual can be responsible for. So the first collection alternative that the IRS will consider is, do you have the ability to full pay the IRS? Meaning, do you have assets or income that could full pay the liability at one time? Do you have a savings account? Maybe it's a 401k or an investment account. If you sold some property, would that full pay the liability? We will talk more about your main home or homestead later in the course. But don't worry, the IRS doesn't want to sell your home, but they may want you to pull the equity out of it to full pay them. Can you borrow the funds? Can you go to the bank and take out a loan? Many times, borrowing from a bank would be much cheaper than to borrow from the IRS. Remember, the IRS tax on interest and penalties, and by the end of the year, you could be paying more in interest and penalties than you would on interest on a personal line of credit or a loan from your bank. See, the IRS takes the view that if you owe them, you really shouldn't have a savings or an asset before them. Their debt reigns supreme to them. So outside of necessary living expenses, diverting income into an asset that's accumulating in wealth or a savings can be frowned upon. They want that asset. There are some exceptions, but just remember, if you can borrow, get a loan, or liquidate an asset to full pay them, they will expect that, and many times they will demand it. So what if you don't have the money now, but you expect to have it soon and you can full pay it then? Well, then you can ask the IRS for an extension to pay. An extension to pay gives taxpayers 120 days to full pay. It's a great option if you think you can come up with the money in full, but you just need a little time. And they are easy to get. As long as you qualify, all you have to do is call the IRS and ask for a 120-day extension. They will see if you qualify, and if you do, that's 4 months that the IRS will give you to full pay the debt. The second collection alternative is an installment agreement. In other words, do you have the ability to pay the IRS in a payment arrangement? We're going to be spending most of our time in this course on that collection alternative. But first, there are two types of installment agreements, streamline and non-streamline. So when you ask for any collection alternative with the IRS, typically they want to see what your income is and what your assets are. In a streamline agreement, it doesn't necessarily require you to provide proof of your income or assets. And in some cases, depending on the size of the debt, it's very simple to get into an agreement. So if your liability is less than $10,000 or $10,000 or less, you're guaranteed an installment agreement if you meet certain requirements. You can also void a tax lien if you enter into a direct debit agreement. And we'll talk about that a little later too. You don't need to show any proof of income or expenses. If your liability is $25,000 or less, you can also avoid a tax lien if you enter into a direct debit agreement, and you can full pay the liability within 6 years. Again, there's no need to show any income or your expenses. If your liability is $50,000 or less, you can also get into a streamline agreement. You can avoid a tax lien if you enter into a direct debit agreement and full pay the liability within 6 years. No need to show proof of income or expenses, and you can expect a monthly payment plan of close to $750 a month if the liability is $50,000 or less. Now, a non-streamline agreement will require verification of your assets, expenses, any debts, as well as your income. You're going to have to complete some financial disclosure forms called either 433As, 433Fs, 433Bs if you're a business, 9465 if you're asking for an installment agreement. Here we have an example. Michael and Karen owe $24,000 in income taxes. After completing the form for the Streamline Agreement and speaking with an IRS rep, their monthly payment is $330 for 6 years. Michael and Karen are unable to pay $330 a month. So Michael and Karen can opt for a non-streamline agreement and provide their financial information to determine what their payment amount could be. If their financials prove they have the ability to only pay $150 a month, their payment arrangement will be only $150 a month. But in order to get that type of a payment arrangement, they have to show verification of their assets, their expenses, their debts, and their income. And we'll get more into that later in the course. The third collection alternative is hardship. If your expenses exceed your income, then you can claim hardship. If you claim hardship, the IRS will require proof. They will go through all your income and expenses to verify. Income includes Social Security income too. Sometimes many people think that the only income they have to report is the income they get from their jobs or wages. But if you earn income, any type of income, if you receive unemployment, Social Security, rental, passive, gambling, any income from any source, they will use that in their computation of how much you can afford to pay. So all income is considered, even though maybe all expenses will not be considered. But if you are in the red at the end of the month, then you can ask for a hardship. A hardship means that you're unable to meet your basic living expenses. When you find yourself in a hardship, you can request currently non-collectible status. Currently not collectible status is an imaginary status that your tax account will go into. It's a dormant status. You as a taxpayer acknowledges that you owe the tax, but the IRS acknowledges that you cannot afford to pay it. So they put your account in a dormant status, meaning they will not attempt to enforce collection or collect from you while the account is in that status. But interest and penalties will still accrue. This is a good status to be in when the statute of limitations will run, or if you're experiencing a hardship. But even when you're in a hardship status, I tell my taxpayers to still make a payment when they can. Making voluntary payments is a good way to help keep down on the liability because the currently non-collectible status is just temporary. Sometimes it's only good for 1 or maybe 2 years, but after 2 years, the account comes out of the currently non-collectible status and the IRS resumes enforcement or collection. And many times your balance is now higher due to the interest and penalties accruing. So when my taxpayers find themselves in a currently non-collectible status, I generally advise them to make voluntary payments or see if they will qualify for the next collection alternative, which is an offer in compromise. The third collection alternative is an offer in compromise. Have you ever seen the commercials, hurry, act now, time is running out? Settle your tax debt for less than what is owed. Well, those commercials are talking about an offer in compromise, and they can be misleading. The Offers in Compromise program has been around for a long time. It's not a new program, but the recently enacted Fresh Start Initiative program does make the offer in compromise process easier for taxpayers to be considered and receive a settlement. And that's what an offer in compromise is. It's a settlement of your tax debt. This collection alternative is probably the most difficult to get. It's an extreme collection alternative that the service provides, and the burden is on the taxpayer to prove it's in the government's best interest to accept your offer. Once you submit an offer application, it may take 8 to 12 months for the service to begin working on your settlement request or the offer in compromise application. And because it's the most extreme collection alternative, the service will scrutinize every expense, every asset, and all of your income. They do this to determine your reasonable collection potential. In other words, how much can they get from you? The offer process will squeeze every last penny from you. We often get taxpayers who want to bypass discussing other collection alternatives and skip right to settling their tax debt. In fact, most people who come to us want to offer some amount to wipe out the rest of their tax liability. But when we look at their assets, they may have the ability to full pay the IRS. Maybe they have a retirement account or a couple of homes that have equity in it. The IRS is not likely to allow you to continue to own an asset that, if liquidated, could full pay them while still settling your tax debt for less than what you owe. The IRS generally wants the value of the asset, or they will require you to liquidate the asset for the offer. Another reason people may not qualify is because of their income. Maybe the taxpayer has the earning capacity that could full pay the IRS within the collection statute expiration date or the statute of limitations period. The IRS has 10 years to collect on your tax debt. So if it looks like your monthly disposable income could full pay the tax debt within the 10-year time period that the IRS can collect from you, well, then the IRS will most likely deny the settlement request. The IRS will accept an offer if it's in their best interest. If it doesn't appear that it's in their best interest, not yours, or you cannot show why having an asset shouldn't be counted against you, then it's likely they can deny or will deny the offer. It's the taxpayer's burden to show why there exists a special circumstance that the service should consider and accept their offer. For more information about offers in compromise, schedule a consult or a one-on-one coaching session with us. You can also purchase our course on how to successfully settle your tax debt with the IRS by visiting our website. And finally, the last collection alternative is not one that the IRS actually offers, but it is available to taxpayers when they qualify and when one of the above collection alternatives will not work for them. Bankruptcy is sometimes stigmatized, but the benefits of filing for bankruptcy is that it really provides a fresh start. If you're swimming in other debt, including owing taxes, then you may want to consider bankruptcy. As tax attorneys, we can advise you on how to resolve your tax problem, but your tax problem may be one slice of the pie of your overall financial issue. You could have other issues like judgments, credit cards, facing repossession, or foreclosure, and that's when you want to consult with a bankruptcy professional. When you file for bankruptcy, timing is important for your tax debt. If the debt is old enough, the bankruptcy will wipe it out in its entirety. Timing is also important because depending on when you file for bankruptcy, you may be able to avoid a federal tax lien. If bankruptcy sounds like an option, then consult with a professional regarding bankruptcy. In order for the IRS to begin considering whether to approve your payment plan request, all required returns must be filed. Compliance is key. Compliance means you file all returns, you file them on time, and you pay taxes on time. Yes, I understand that you have past issues, but they want to ensure that you will not continue having future issues. So in order to get into a payment plan, they check to see if you filed all returns that you are required to file and that you are paying enough taxes for the current year. So be sure to have enough withholding coming out of your paycheck. If you aren't certain, talk to your HR department. If you are self-employed, make sure you're making sufficient estimated tax payments or prepayments towards your future taxes.